A lot of people get rejected because like, oh, I didn't have a 620. I'm like, you don't need a 620. Usually your first credit card, most people don't ask for that increase in balance limit. Get their first credit card after their first big boy job and they're probably making X amount. Then 3, 4, 5 years later, theoretically you should be making more, but your balance is still the same.
Credit is recoverable. You know, people feel like they should already know this, and it's like people sometimes feel very vulnerable about their credit. If their score was at a 500, we would look at what is affecting the score. What areas can be strengthened? What areas would we be able to dispute?
Life happens. No matter how good you think you're doing, your situation might be tough, but also what Maddie says, not forever. I think the best way of overcoming any obstacles in life is just have a game plan.
Low-key is kind of frustrating navigating this. They want you to use the credit card. They don't want you to use it too much. They want you to pay it off, but they also want you to carry a balance because that's their business model. So it's kind of like, yo, how do you even do this thing? How do I win? Yo, so if you're enjoying the Blueprint podcast so far, I want you to give a big round of applause for Josh David with CTC Mortgage. Not only is Josh a guest on the Blueprint podcast, Josh is also one of our amazing sponsors. And because of him, we're able to execute these podcasts at a really high level. So if you're enjoying the topics, the quality of the video, just the overall ambiance and vibes of the show, man, that's because of him. And you know, the reality is that there's a lot of different lenders that can help you get pre-approved for a house or help you get a mortgage on your, next investment property. But the reality is that Josh is a lender that shares the values of this show. He loves the Lord, he believes in education, he's down to earth, and he wants to empower you to make the right real estate decisions. So if you're looking for a lender for your next property or your first home, we're going to have his information in the description so you can check that out. You can also check out some of the episodes he's been on, so you can actually hear from him what values he brings, what makes him different, and why you should use him for your next or your first home purchase. And let's go ahead and get back into the show. Well, welcome to another episode of the Blueprint podcast. But real quick, I have a question for you. Do you know what your credit score is? Like, really, do you know your real credit score? Well, today we're going to be talking about how you can either raise your credit score, leverage it to get a house, and the things that you need to know to prepare yourself financially to buy your first house, your next house, or just get more financially stable. And so I have brought in some experts. They do this every day. We have JD, who's a mortgage lender. We have Maddie, she's credit recovery. We all are a team, and we're going to be basically giving you the information you need to know to be able to get your credit in the right place and get your finances in the right place to buy a house. So let's go ahead and get started. So why don't we have you guys just introduce yourselves? I gave a quick intro. They kind of know what you do, but why don't we just kind of go a little bit deeper, tell us a little bit more about your business, where you're from, what you do. So we can start off with you, Maddie.
All right. Well, hey guys, I'm so excited to be here and so glad to have been invited. So for me, with credit restoration, I've been with Clover for a couple of years. I started out originally as a loan officer.
Okay.
And so I was in lending for a couple of years, and then I met my now business partner who had opened up her company back almost 5 years ago.
Okay.
So I was sending her my credit restoration clients, and one day we were doing an event together, and she was like, man, I'm really, she was growing. And so she was like, I'm going to have to hire somebody. And I remember that she said that.
Yeah.
And then I think it was like a couple months later, I was like, hey, what do you think about us working together?
Yeah.
And she loved the idea. And so that's been almost 2 years now.
Okay.
And so it
Love
was
it.
a really good switch. And I'm glad to have been able to apply the knowledge I had from my years in lending to credit restoration, because our niche is home buyers.
Okay.
Clients, realtors and lenders that have clients, or clients in general that are looking to purchase a home. So I wanted to transition into something where I could still use that knowledge, and it was a really good fit.
So good. Love it.
Yeah.
Okay, cool.
Well, hey, glad to be back. Thanks again.
Second time on the Blueprint podcast. Congrats.
Let's go.
You're like a legacy member, bro. We're just going to have you back every couple months, bro. You're just going to be on rotation.
Yeah, little do they know I slide you a 20. Just kidding. I know. But hey, just like last time, I'm a mortgage broker, right? So I'm in the mortgage world as a loan officer. My goal is just to help leverage mortgage products to help people get home ownership, and depending on their game plan, if they want to grow their real estate portfolio or not, we just help them achieve their goals, right? So
absolutely.
As a broker, we have access to anywhere from 50 to 100 banks. So there's always some type of solution to their game plan.
Yeah,
so it's always fun to figure out, hey, what can we do? Great. We got 3 options. Pick your poison.
Yeah, absolutely. Okay, cool. And me and JD went viral on TikTok a couple weeks ago from our episode talking about one of those creative opportunities, right? So we'll link that in the description. You can check that out. But let's go back to credit recovery, because I know, I think most people can fill in the blanks of what that means. But can you kind of just explain us what actually that means?
Yeah, so we refer to it as credit restoration or credit repair.
Okay.
So with credit restoration, we use a law called the Fair Credit Reporting Act, which I'm sure you guys may be familiar with.
Yeah.
So in this act, it contains over 300 laws that have to do with the way that things have to be reported in consumer credit reports. So
Okay.
first things first, when we look at a client report, we identify any areas of discrepancy. So where are those reports not in line with that law? So is the collection not in all three bureaus as it's required to be? Is the date of last activity not reporting the same in all three bureaus? So we identify those discrepancies, and if we have grounds, we dispute on the client's behalf with the credit bureaus to try to have the accounts removed. So
Okay.
I always explain, we're not disputing the validity of the debt, but rather the way that it's reporting is not in compliance with
Okay.
those laws.
So y'all are like attorneys. Y'all are like looking for the loopholes, basically, to kind of help
Something
people.
like that, yeah, something like
Okay.
that. And so that's what we focus on. But then when we do a credit analysis, I always explain to the client, we look at our side of things, which would be the disputing process, but also a game plan for how to improve the existing areas. So we look at, do they have open revolving accounts? How many do they have? Do they need a credit building account? Where are the balances on the revolving? Do they have an installment
And
account?
what would be a revolving? What would be an example of that?
So a revolving account would be like a credit card.
Okay.
So an account that you use, pay down, and essentially can keep doing that forever.
Right.
With an installment account, that would be like an auto loan.
Okay.
Or like a furniture purchase where it's a certain amount, you're paying it down, it's the same amount every month, and then once it's paid off, the account is closed. So when we look at the credit profile, we're looking at several different things. So mix of credit, we're making sure that that's where it needs to be. Amount owed is a large portion of what makes up the score. So that's why we look at, where are the revolving accounts, where are the balances. And so we take a more all-encompassing approach, not just like, oh, we can do this, sign up in services. It's like, what needs to be done on both ends to see the best results?
Gotcha.
Yeah.
Okay, love it. And so for JD, like, what credit score do people need to have to buy a house? And like, at what point would you then refer them to talk to Maddie?
Gotcha. So depending on which program we're doing, right? There's multiple loan products. I'll go over some basics before going to nuances, but
Okay.
conventional 620 or higher.
Okay.
FHA 580 or higher, and in most cases, if you got 10% down or more, we could do as low as 500.
Okay.
VA, according to the VA handbook, there's really no set score. So
Okay. Wow.
if
So
you get
veterans, it doesn't even matter.
it doesn't, as long
Okay.
as you got money and we
Okay.
can make it work,
Okay.
we're good. But a lot of people get rejected because like, oh, I didn't have a 620. I'm like, you don't need a 620. As long as, hey, we get your loan approved and the
Okay.
VA takes it, you're good. So I've gotten some pre-approved as low as 500. So
Okay.
it's
Amazing.
possible.
Yeah.
But yeah, every bank has different rules on that. So depending on which lender you talk to, they'll say
Okay.
600, 620. And I'm like, there's really not.
Yeah. Okay. So basically, it depends on like if they're going FHA, VA, or conventional. There's different limits on their credit score, and basically, if they're like, "Hey, we're gonna go FHA, but we're like at whatever you said, it was 520."
As low as 500 on FHA if they
500.
have 10%.
Okay,
or
so
more down.
500 is already fairly low, right, Maddie? So like, I mean, in that scenario, if they couldn't qualify for that, is that a scenario where someone would go to you, or like, what would that situation be like?
So if their score was at a 500 and they were, say working with JD and they didn't have that 10% down,
Yeah.
then we would look at what is affecting the score. So
Okay.
at that point, we would do an analysis, do the credit analysis, and make a game plan. So we would look at what areas can be strengthened, and then what areas would we be able to dispute. Now, a lot of times clients, they may have a shorter time frame. So I would always like to have the conversation with them that, at a point we can go ahead and dispute everything, but would you be open to settling on any collection accounts? And then we walk them through that process of requesting a pay for deletion letter and being sure that they have the terminology they need, because a lot of times what happens, like for that example, if they pay a collection and don't request a pay for deletion letter, it doesn't necessarily come off of the report. You have to request certain documentation. So it's just giving them that information. But in this case, that would be a good one where I would want to do an analysis and see what's going on.
Okay, and how long does it typically take to bump up someone's score? So, and obviously I know it's super nuanced, but like, are we looking at like 3 months, 6 months? Is it like 30 days? Like, what's kind of the general rule of thumb?
So it really depends on what's affecting their score.
Okay.
We have clients that just needed to pay balances down on revolving accounts, or maybe they had no credit score and they needed to establish their score. That can be a pretty quick turnaround. We had a client a couple months ago that a lender had referred over. The client had no credit score. We give them some recommendations, open these credit building accounts, get this installment building account. And within a month, they had a 700 score, which is crazy to start off like in a great spot.
Yeah.
So it depends. Some clients, if their scores are in the lower 400s, we're probably looking at closer to a year.
Okay.
So, it varies. But if we have a client that's around the 580s, just a couple of charge-offs, collections, high balances, it can be as short as 3-7 months. But again, it depends. And I also stress to the clients the recommendations that they need to do. That's a big factor in how soon we can see changes. Because the way I explain it, like our side of things, the disputing, that's cleaning up and clearing off the old and negative accounts, but building, establishing, and maintaining the positive credit is crucial, because even if we clear off every negative old item, you're not going to see the increases that you want unless the balances are low and the sufficient revolving and installment accounts are there.
Okay, gotcha. Okay.
Yeah.
So JD, in terms of like someone who maybe we just gave an example of like, okay, that would be someone who's in a really tough situation if they're at the 500 mark.
Yeah.
Let's say someone is in, let's say, the high 600s, low 700s. Would a credit like what a credit, what was the terminology you
credit
used?
restoration.
Credit restoration. I don't know where I'm getting recovery comes, but credit restoration.
No.
Okay. Would you still send someone to Maddie in that scenario to maybe help them get a little bit better rate, or does it not really matter at that point if you're, the difference between a 690 and maybe 720? Like, is there actually like savings in that?
So the answer is always going to be, it depends, right?
Okay.
So if they're in a short time period that, hey, we don't really have time, usually I hit up Maddie, I was like, hey, is this possible in like 2 months? Either it's a yes or no, or it's a maybe, depending on the situation. But if it makes that much difference in the payment, I tell the client, hey, if you're willing to go through this the next 3, 6, maybe 9 months, great, go for it. And every now and then, I think we're just adding that scenario we had not too long ago. We had a client that, so we pre-approved him at 729. So with his situation, he only needed to put 10% down on an $800,000 home. So only $80K down.
Okay.
He paid off some car loans without telling me.
Okay.
And lo and behold, about 30 days later, we look at his credit, we're like 696. So that difference in it, he went from putting 10% down to 20% down in order to get the loan to work.
Oh, dang.
So,
okay.
and
Wait, but he was paying down his debt though, right?
You logically,
You would think,
right?
That would be good.
So I think Maddie might be better explaining
Okay.
that. But
So is that because he had his debts, or he had less money now, like in terms of the debts, other debts that maybe he had?
So it probably it may have affected that, his overall amount that he had saved. But what the main thing that most likely caused that drop was closing an old installment account.
Oh, gotcha.
So
Okay.
a lot of times, if an auto loan is paid off, it will drop the score because that was an existing installment loan with length of credit history. So the important thing to remember is length of credit history makes up 15% of the credit score. So if they had an auto loan for 3 or 4 years, each month that it's on there, it's strengthening the credit profile. So then when it's paid off and closed, that positive factor that was helping contribute to the credit profile is like gone. It's on the report, but it's not there as an open line. So that's where we see that. So in that case, that would have been great if the client would have reached out to you.
Yeah, because then you would have told him what to do.
I was like, hey, before we do anything, let's talk to Maddie. Just know that, hey, because from what I know, anytime you pay off an account and it's closed, usually you take a hit because it's a closed account. Then it takes about 30, 60 days before we see it go back up. And I'm like, hey, we're in the home buying process. The next 39 days is crucial. Don't move money around. Don't change up your credit. Don't get a new line of credit or anything like that. If you have to, let me know, because, hey, life happens. But he thought paying off debt, good thing, which normally it is. It is a good thing, but not in the home buying world.
So he should have paid off the debt before he started the process, and that still would have hurt him.
Well, it depends on his timing, right? If he paid it off before he called me, then his credit would have dipped. But the thing is, people don't realize you could pay off that debt during the home buying process. So we can take off that debt against your DTI, so you have a lower debt to income ratio. So we could pay it at closing and does not impact your credit score. So most people don't realize that.
The best option.
Yeah, I like just pay it off at closing. We're fine. That way you're
okay,
happy.
so it would like happen the same day as closing, or
Yep.
like okay,
Yeah, so
that's
again,
so interesting.
talk to
See, this is why I love real estate. There's so
Yeah.
many creative, cool things that you can do, and someone said earlier, like you have to just engage with the process. And so I'm like, yo, if you're trying to buy a house and you have questions, like just start talking to people. Like, I mean, this scenario here, like you guys working as a team could have really helped this guy, and I'm sure y'all still did help him, right? But like, there's some really cool things that could have happened. But if you don't know what you don't know, so you have to really be building those relationships. Even if you're not ready, hey, talk to someone so that you can get a game plan, so you can know going into it. Okay, hey, I'm gonna pay off my car, but I'm gonna save it. I'm gonna save that money and then use it, right? Or you could be like, hey, Josh could be like, hey, actually, you don't need to pay off the car. Let's use that money to get your down payment a little bit bigger, so we can get, you know what I mean? There's just so many different things that you can do. So
And there's no such thing as a dumb question. I think
Yeah.
people are scared to ask, and they're like, "Oh, that's
Yeah.
a dumb question," or "I should already know that." But like,
yeah.
majority, like, if
Yeah.
I wasn't in this industry, I wouldn't know
Yeah.
any of these things.
Yeah.
If I wasn't in it.
Yeah, absolutely. And that's so funny because, like, you know, when we went viral on TikTok, the comments were just, there were so many misinformed people. I was just like, this is breaking my heart because so many people just don't know what they're talking about. And they're getting their information from God knows where.
Some uncle and auntie on WhatsApp. It's
Yeah.
always some
And
older
so
person.
it's crazy. Okay, so something that Maddie, you taught me that I didn't know. It's so crazy. I mean, as an agent, I'm like learning all these things, right? So the different types of credit. So you talked about the revolving, yeah, all those kind of things. So in terms of the credit score, I most of us have like Credit Karma or whatever our bank apps have, like the different, like here's your score, here's your FICO score. So that's actually different than the score that Josh looks at when he's pulling someone's, right? So explain that difference.
Very much so. So there's many different scoring models. Typically, the one that's on the banking apps is called Vantage.
Okay.
So what they look at is different percentages than what a lender would pull. So basically, what makes up the score, the percentage of, like, say, late payment, it would be different for different scoring models. So even within the FICO scoring model, there's FICO 8, FICO 2. There's several different versions. So clients do get frustrated with that sometimes. They're like, well, I checked Credit Karma, or I checked, you know, whatever the case was, and they're like, it's different than what my lender told me. What am I supposed to look at? And I say, always look at what the lender pulls, because that's a hard inquiry. You know,
Okay.
when we do an analysis, we use a credit monitoring system. The one that we use is called MyScoreIQ, which we prefer that one. We recommend that one because it does give us access to one mortgage score and Experian.
Okay.
So those can vary so much from the consumer scores. So that's another important thing too. If you have a client that's looking to purchase, that they're looking at the mortgage scores. My FICO is one that a lot of people recommend too. That's a good one because it has the scoring model for mortgage scores. But that's what I always tell my clients is the hard inquiry is going to be the most accurate. But you know, MyScoreIQ or My FICO are great resources as well if they're wanting to monitor.
And so should JD, in terms of the process, I know we've talked about like the pre-approval process. That's kind of the first step people should typically do to kind of get an idea like where they're at. So do you think that they should do kind of that route before they do their pre-approval, or should that happen around the same time?
I always tell people, hey, talk to me 6 to 12 months before the process. That way we can always
to do the pre-approval, or just talk to you just to kind of
talk to me. We can do a pre-approval. Talk to me, because depending on your situation, we could do the pre-approval right then and there and figure out what the red flags are, what we got to do to strategize on, hey, what we could do to get a better rate, or hey, what we could do to get a better score to get you a better program or get you qualified for a grant. And the quicker, and like, it doesn't hurt to talk to people in advance, right? We're always supposed to talk to our doctors probably earlier than later, right? So in the same way, I'm like, hey, the worst case, we're just gonna give you more information that's needed for the process. But yeah, I just forgot your question right now.
So I was just basically asking like, what time should they be pulling their, you know, their FICO scores or credit scores to kind of find out which, you know, their Advantage score, like the different what's the timing opposed to like when they should talk to you too?
Gotcha. So when it comes to the home buying process, most lenders let the credit report be good about 60 and 90 days. Every now and then, somebody might accept a 120, but most of my lenders 60 and 90 days.
60 to 90,
so if you want to get under contract, we're probably going to talk to you about 30 days or 60 days before. We'll get your credit. And sometimes that gives us enough time to fix things up, or hey, that's your score. That's what we got to run with.
Okay, gotcha. Okay, and what do you think, and this is a question for both of you guys, what are some of the biggest credit problems hurting people, right? So is it like credit cards, student loans, car payments? Like, what are some of the big ones that you think, or maybe not, maybe ones that most people wouldn't think of that you're really impacting people right now?
You want me to say one?
Yeah,
y'all can both go. Yeah,
Oh,
I'm gonna
okay,
say
okay.
both of you guys.
Gotcha.
Yeah.
I think what I didn't know this for a long time, so I know other people probably don't know, but usually your first credit card, most people don't ask for that increase in the balance limit, right? They just get their first credit card after their first big boy job, and they're probably making X amount. Then 3, 4, 5 years later, they're probably making more. Most people should be making more, but theoretically you should be making more, but your balance is still the same. So people forget to ask for that increase, and if you ask for that increase, your debt utilization actually decreases, right? Since you have a higher balance. So I think people are forgetting to do that every now and then, especially when they are increasing their salary at their job. So I think that's a big one that most people don't know, and most people don't even mention it.
Okay, so would this be, and this might be a Maddie question, would it be a good strategy to open up a lot of credit cards and then increase them over time, or no?
So we typically recommend between 2 to 5.
Okay.
2 is enough to establish and build credit. At a certain point, if there's 6, 8 cards, that becomes pretty difficult to manage, and it can be easier to lose track, miss a payment, then you may be accruing more interest. So I would say, 2 to 3 cards is good, and just maintaining those with low balances, and that should put you in a good position.
Okay,
Yeah.
gotcha.
But as far, I agree too, asking for the increase is not a bad thing at all. I would say maybe once every 6 months, once a year even. But the most important thing is still maintaining the low utilization. And I would say for best results, between $10 and 10% of the credit limit.
Okay.
So
So
I
it's
know
within $10 or 10%. So if your credit limit is $5,000, you need to be at like what, 4?
I would say $10 to $500 and not exceed
Okay.
$500.
Okay. In terms of what you carry on a month-to-month basis, if you're not paying it all off every month.
Yeah, exactly. So I would say not to exceed, and it gets confusing because some people say, oh, we'll pay it twice, pay it here at the end of the month, and then on the closing date, and then when it's due. But really, as long as the balance never exceeds 30, you don't really have to worry about paying it multiple times, because the point with which it hurts you is when the utilization is at above 30%. So as long as it's maintained there, but again, for the sweet spot, 10%, between $10 and 10% is going to help you not only have less debt, but the account's going to work for you because it's showing that, hey, I don't need to utilize all that's there, and it will in turn help to score.
Yeah, and I'm so glad we're doing this episode because it low-key is kind of frustrating navigating this because, like, okay, the credit card they want you to use the credit card. They don't want you to use it too much. They want you to pay it off, but they also want you to carry a balance because that's their business model. So it's kind of like, yo, how do you even do this thing?
How do you
like,
win?
how do I win?
How do we
And it's
play
like,
this
okay,
game?
do I pay twice a month? Do I pay on the balance date, or do I just like, you know what I mean? And like, I totally get why people are frustrated. I totally get why, sometimes it gets out of control for people because it's just like this like wild west is what credit feels like to me, right? And especially in this economy where, a lot of people have used credit cards more than they ever have. I've used credit cards this year more than I ever have in my life, right? And just knowing, okay, how do I do this? How do I do this with integrity? How do I do this the smart way? It's just kind of really hard, right?
It
And
is
so,
tricky.
what are some other things that you guys would recommend in terms of navigating a tough economy? And I say this with compassion in my heart because I think most people don't get into credit because they're just dumb, right? I think most people are like in hard situations and they're just trying to make life work, right? And sometimes stuff happens, a car breaks down, a kid is in the hospital, like these things happen. Yeah. And so like, I mean, what are y'all's thoughts on that in terms of how we can really help people with kind of just a tough go at it sometimes?
I would say for me, we do have clients that have been through all types of situations, identity theft, bankruptcy, very difficult things, divorce, sickness, like you mentioned. And I would say, it's letting them know that there is a way to recover from it. It's not forever, credit is recoverable. And, it's just being supportive, honestly, and saying, like you said, regarding something else, you were like, people feel like they should already know this. And it's like people sometimes feel very vulnerable about their credit because they feel like they shouldn't have let it get that way. But the reality is life does happen. And, it's just being there and being a resource to educate, but also, like you said, having a little compassion to say, you know what, it's okay. We're going to give you the information and the tools that you need so that you can move forward feeling knowledgeable, feeling like, you can overcome it and basically help guide you to where you want to be, whether it's homeownership or purchasing a new vehicle. So I think it's important in any aspect of where you work within the real estate world.
Yeah, and I want JD, I want you to answer. I want to say this real quick. I think like the piece that I think is so impactful about what you do, Maddie, is the educational piece of that, because there, like we talked about, there's going to be life things that you just can't avoid, right? We can't say, hey, don't get in a car wreck, or like don't get into like, you know what I mean? Those are the things you can't avoid, right? So once you're in it, but then like once you've maybe gone through the process once, you kind of know how to navigate it the next time. Like you have the skill sets, you know the things, you know the strategies. So that's why I think I'm like I think it, even for somebody, like, would you say, even actually that's the second question, I'm gonna come back to this, I want to hear your answer, but like even if you're not in credit like problems, should you still talk to a credit person just to kind of like understand it more? But
definitely.
Okay, so answer your question, because I'm like, there's so many questions in my head, so I want to hear you talk to JD about kind of that first question.
So I think so I haven't, not many people know, but before I was an actual licensed loan officer, I was working in the foreclosure and bankruptcy world. And I learned really quick that, hey, life happens. No matter how good you think you're doing or whatever, like it happens to everybody. I think the most important thing is just have grace and compassion, because, hey, your situation might be tough, but also what Maddie says, not forever. Right. So we can go through it. I think the best way of overcoming any obstacles in life is just have a game plan. Talk to people. And I think also another problem we have in our society, maybe my community or everybody's community in general, is like people don't want to bring it up because they feel shame, they feel looked down upon, or it's like, oh, you should have known better. We told you this. And like, even if you know it, like life happens. We can't control life, like people divorce, sickness, kid gets sick, whatever. So I think when it comes to that, it's just like talk about it, reach out and ask for help. The quicker you ask for help, the quicker we get a solution, the quicker we get a game plan, the quicker. And also, I think it also gives people hope that, hey, this is solvable. It's not forever. We can overcome this together. And I think people don't give enough credit to the point that a small thing can give you a big impact. Even if it's even if it's just as much as putting an extra $5-10 towards a credit card payment, like, it makes an impact. Or hey, save an extra $10-20 to the side, or just doing small impacts. Because a lot of people might think, it doesn't matter, doesn't make sense to even save it, or it doesn't even make sense to put it on there. But I'm like, if you did that for consistently, you made it a habit, you're gonna have
it's a lifestyle.
And it helps your mentality, it makes it a lifestyle, it makes it to the point that it's automatic. And it makes overcoming those obstacles much easier, because you already built that mental muscle, that mental fortitude on overcoming it.
Okay, gotcha. And so you mentioned like asking for help. So Maddie, what are some of the things, like ways people can ask for help? So we talked about increasing your debt utilization by basically just increasing your limit on your credit card. So that's one. Like if you anticipate you might get in some trouble later in the year, just kind of creating some space for yourself. I think you had mentioned balance transfers, potentially request a temporary rate reduction. Talk about some of those other things that people can do to kind of like, what are the lifelines that they have?
So if they do find themselves in a tricky situation where there's high balance cards and they're having a difficult time managing it, we don't recommend debt consolidation, just because depending on the company you use, sometimes it can end up very negatively impacting your score.
Okay.
So what we typically recommend is a balance transfer with a credit union, where or a personal loan where they're able to consolidate the debt, possibly have a lower interest rate when consolidating, but they're not at the mercy of a debt consolidation company, which again, depending on the company, they have different practices, which is a whole other topic. But yeah, balance transfer is great. And then sometimes you can even call your credit card company and say, hey, if they're going through a financial hardship, say, hey, would y'all be able to temporarily reduce my interest rate? Some banks will not do it, but some will, and it's worth a shot, especially if they do agree to do that. So, but our best recommendation is really balance transfers, because it doesn't put them at the mercy of a debt consolidation company.
Okay, gotcha. Okay. You got anything you want to add to that? I know that's kind of a main question for her, but is there anything like kind of thoughts that you think when you say asking for help, what do you mean by that?
I think it's just going to the people who share the information directly, right? Yes, as much as we could Google things, and yes, we might learn a thing or two, it makes it so much easier to go straight to Maddie, be like, hey, here's my scenario, what can I do? And she's going to give you like a good couple options, go through and just walk you through it. And it's much easier when somebody holds your hand and gives you sound advice versus you talk to an uncle or a parent. And sometimes they might have good advice, but it might be outdated. Their advice might not be today's best advice.
Okay. And the other thing too is, anytime someone has a credit concern, we do a free analysis. So it doesn't hurt them to just get a review of it. And sometimes we do them and they're like, oh my God, I was so stressed. And it's actually not that bad. I'm like, yeah, you're good. Just work on bringing on balances. So it's just sometimes having that peace of mind and just taking a look at it and then just not having to worry about that anymore if it is something that's easy to resolve.
Yeah, absolutely, absolutely. JD, talk about, we're kind of coming on the end of the year. We're in November. I think there was a lot of hype this year about interest rates finally coming down toward the end of the year and then going into 2025. And it's kind of like, we're like kind of starting to creep back up again. Obviously, people are kind of doing the math. I think really smart consumers kind of know some of this stuff, and they kind of know, hey, like, okay, I have a high DTI and interest rates are coming up, so I know that might impact my affordability. Are there like any recommendations you have for someone who is in that maybe the 3 to 6 months and they're like, hey, we really want to buy a house or buy our next house or sell our home? What are some things you would be telling them that are relevant to kind of the environment we're in right now and projecting out the next couple of months?
I think what's really relevant right now, especially with rates, because with that 50 basis point they announced, ironically, the last 30 days rates have gone up a full percent. So it doesn't take. We're not in that place where we're seeing the lower rates now, but right now what I'm seeing a lot of people are doing in the real estate world, they're just asking for seller concessions from the sellers. That way they could do a 2-1 rate buy down.
Okay,
that way
explain what that is.
So 2-1 rate buy down. So based off of, let's say for example, base rate 7%. 2-1 buy down means the first year 2% reduction. So instead of a 7, you're paying at a 5. Now on year 2, you're paying at a 6. Then it goes back to a 7. So that's basically what.
So is that an adjustable rate mortgage or is that?
Nope. Okay. So it's gonna be a fixed rate. So that's a little different. So adjustable rate mortgages, it can be locked for 5 years and it fluctuates. It can be locked for 7 years, and there's so many different arms out there. So I don't want to go into that. But with this one, it's a fixed rate. The first year it'll be at 5, second 6, then 7 for the remaining years of the loan. And that's assuming you're keeping that same loan for 30 years. Most people aren't. They're probably going to refinance by that point.
Yeah, or sell their house in 5 years and it won't matter anyway.
Yeah, so.
Okay, so with that strategy, I'm assuming would you recommend people save the difference and then use that to refinance when they hit that 7 in your example?
Yeah, with that scenario, it's just, hey, you're able to monitor rates while having your 5%, and depending on what the rates are at that time, you can see, okay, does it make sense to refinance now, or let's just wait till next year? Because hey, you might be at a better spot. The market could be, or your 2-1 buy down could be a better rate than what the market is. At that point, that lengthens the time before from your purchase and your refinance. So that for you don't have to pay all those closing costs at that time.
Okay, so explain the refinance process, because I think we throw that around, and for first-time home buyers, they obviously won't have ever gone through that process, right? So maybe somebody who's, if you've owned a house for 10, 15 years, probably in this last 10, 15 years, you probably refinanced. Definitely in 2020, people were everybody was refinancing,
I think everybody
right?
did.
So
if
pretty much,
I'm sorry.
Yeah, most people know who owned a home before, they know how that process works. For the people who are buying homes now, it might be in the scenario we're talking about. What is a refinance? How does it work?
So refinance is basically like a mortgage redo, right? So whenever you bought your home at a 7%, market goes down to like a 6% lower, you're basically calling a lender, hey, can we just redo the note rate on the loan? Great. And the thing I want everybody to know, there's no such thing as a free refinance, right? People advertise it because there's no money out of your pocket, but they're probably using your equity to pay it off. So it feels free, but it's not free.
Okay, so if you had $30,000 of equity in your house and you used 10 of that to refinance, now you only have 20% equity?
Or 20,000 equity.
Okay, 20,000, yeah.
And people feel like it's free, and they're like, oh, well, so-and-so is promising free. I'm like, it's kind of hard to promise free unless you see every single line itemized on the disclosures that says $0.
And will that make your payment go up, or like how would that?
Because they're using your equity, therefore your loan increases. So they're adding a buffer into it. So
okay, so if you're gonna refinance, you should just pay cash.
If you can't, well, it depends, right?
Okay.
It depends on, hey, what's your game plan on keeping the home? If they're not going to keep the home after a certain time period, might not even make sense to refinance anyway. Just sell it. Or, hey, if they have goals renting it out, it might make sense because, hey, they might break even within a certain time frame. I personally think people should break even between 12 and 18 months.
Yeah.
For me to consider it's a good deal for a refinance. Again, everybody has their own opinions and numbers on the break-even point, but it just depends on what their goals are, right? If they want to build a real estate portfolio and they're trying to just leverage it out, pay less interest, and just have a better rate, that way they get cash flow, then great. Yeah, buy it down as much as you can and see if the cash flow calculator works.
Okay.
But that answer is just depends. I
Yeah,
hate
so
saying
yeah.
that answer.
Yeah,
but
absolutely. And I mean,
everybody
that's
has a
kind of what I
different-
want to do, right? Like, I bought my house with the intention of 3 years from now I'm going to rent it out, right? And so
Mm-hmm.
we use FHA, so we have that PMI on there. And so, like, that's not going away. So I was like, okay, I want to refinance, drop the PMI, give us a little bit more buffer room whenever we rent it out, right? Because right now, if we rented it out, like, we would cash flow, like, you know, $100. Like, you know what I mean? So I'm like, dang, I want to get into that maybe $300 or $400, depending on, like, I don't think the rates will go down that low. But, like, it would be nice to be able to get some buffer room, right? So that would be a scenario where you would tell me, hey, don't wrap the equity or don't wrap the closing cost into your equity, because then it'll, like, you might just break even again.
In
So,
some cases, some people, it makes sense to use your
Yeah.
equity. Why not? That's not
Okay.
money out of your bank, right?
Yeah.
So it's just money out of your house.
yeah, absolutely. Okay, so let's go back to credit and let's get into some nitty gritty. Okay, so we're gonna kind of basically create a game plan here for people in their minds for the basics of like paying off debt and paying off credit cards. So Maddie, can you explain kind of what the thresholds are in terms of like what are the different things that they need to do to get in a better position?
Yeah, so first thing would be like what JD said, a game plan. So we want to look at what is affecting the score. So if it's high balance accounts, you know, carrying balances on revolving accounts, I typically recommend starting with a smaller account and working the way up because, and that's the snowball effect, which
Okay.
y'all may have heard of.
Yeah,
but-
Dave Ramsey.
Dave Ramsey.
Exactly. So-
I guess he does say good stuff, right?
Yeah,
It's
so-
always good stuff.
Yeah, so that one is a good tip because on any account, any revolving account, it doesn't matter if it's a $50,000 credit limit or a $500 credit limit, the utilization has the same impact.
Okay.
So it's going to help to start with the smaller cards because it's going to reflect more positively and then, you know, work your way up. It may take a little bit longer to pay down the higher balance accounts, but that would be the number one thing, starting with bringing balances down, or if they don't have these sufficient revolving accounts, get those established.
Okay.
And so that would be a good starting point. And then knowing what makes up your credit score. So most people don't realize that 35% of your credit score is made up of payment history. So that means that's why if you ever had a late payment before, you may have seen a pretty significant drop in the score, and that's the number one factor that makes up the score.
Okay.
Next is amount owed. That makes
Okay.
up 30% of the score.
Okay.
So that's why we're so big on revolving accounts, utilization, because that's where that ties in. And then as I mentioned earlier, length of credit history is 15%.
Okay.
And then you have new credit and mix of credit are 10 and 10.
Okay.
So all those things come together. So that's why when we do an analysis, it's so important that we look at every little thing, because sometimes clients say, well, I just want to fix this stuff. And it's like, well, we want to fix that too, but we have to look at the whole picture because it is going to have an impact. Even if it's creating the, an installment credit building account, that may be the final piece to the puzzle to boost you up those few last points to where you're able to qualify for down payment assistance or whatever the goal is in mind. So
Okay.
I would say that's one of the biggest things is just knowing what makes up the score.
Okay.
And then just committing to being disciplined, like what we were saying, being disciplined with the plan, having that muscle memory to know, okay, I'm not going to max them out. I can't go over the 30%. And again, obviously things do happen. So that does happen. But knowing, okay, this is my number one focus at the top of my list is to get my balances down so that it's not impacting me, because it can impact, an auto loan, your home loan, so many different factors. And so that would be the biggest thing, is just knowing what makes up the score.
Okay. Yeah, and I think that credit breakdown was very helpful. So I appreciate you explaining that the way you did. What's the best credit card to have?
So I would just say when you apply for cards, look at what the interest rate is. So the lowest interest rate that you can qualify for.
Okay.
There's several good ones out there, but it's really just the one where the balance is maintained low.
Okay.
Because either way, it reflects on the score. It's
Like, what about the ones that have like, some of them that have like, there's like no annual fee versus the annual fee? Like, is the annual, like if you pay annual fee, is that actually a better credit card than the no annual fee?
Not necessarily.
Okay.
So there are some cards that are like 18 months, no interest. That's a great option. But, normally there's not a card that has no interest like long term. So it's really just looking at it, and I tell clients if they have a question about a card and they're wanting a travel card, I'm like, send me the details. We can look at it and see, what does it say in the fine print, or what's the interest rate? What do you qualify for? What interest rate do you qualify for on that card? So to see if it's going to be a good deal. But yeah, a lot of times if clients get offers for credit cards, they maybe have like a 25% interest rate, and that's not always a great option, which leads me to something that JD talks about with his clients, which is like opt-out pre-screen. So that's a great resource to where if you're receiving junk offers in the mail for like you're pre-approved and it's not a great offer and you didn't apply for it, opt-out pre-screen will prevent clients from receiving those. So it's a great way to
So how do you get signed up for that?
So it's a link. It's optoutprescreen.gov. .com.
Yeah.
I always forget. I have it saved. I copy paste it to the client. I'm like, hey, and also it gets rid of all the junk mail, but also gets rid of all the junk calls too.
Okay.
So so a lot of people find out the hard way. Once you pull your credit, pull a hard credit, they sell your information to thousands of banks across. They're calling you, bothering you, telling, hey, we got this. And if you fill that out about 72 hours before you pull your hard credit, you're going to get little to no calls. So that makes life a lot easier and smoother.
Okay, yeah, because I definitely have. I got a car recently, and that was crazy. I literally created a burner number on Google Voice because like there was just like way too many calls, and somehow some of them still found my real number. And I was like, "How did you get my real number?" I literally put a burner. I guess they like maybe tracked my email somehow. I don't know, but that was crazy.
I used to be one of those callers back in the day. So
really?
There's ways. We gotta
talk offline. I want to hear what some of those are. What are they doing?
I used to be one of those thousands of banks I used to call people. Please forgive me if I called y'all, but I know better. I found Jesus. And
Thank you. JD's safe now. Okay, good. Okay, so last couple questions for you guys. What resources do y'all recommend for managing credit? But I want to also just say, like, just managing finances in general. Like, what are some of y'all's favorite resources?
I like my FICO. My FICO. Yeah, my FICO. Yeah, that's what I like using when it comes to just looking at credit. I get notifications if it goes up, goes down, somebody pulled it. So for me, I like it. At the beginning, I was a big Credit Karma fan. This is like before I got into industry because it did show me a lot of information. It showed me a lot of basic stuff to learn. So it got me more into it. But again, it's not the most accurate. So if you use it as a tool just to learn about credit, I think it's great. But if you're using it to determine your credit, that's a little too far.
Okay. What about any kind of budgeting apps or like money market account, anything like that you would recommend people do? Maybe for like saving for a down payment, the best high yield savings accounts, those kind of things?
Man, I'm old school. I use Excel sheet to.
Okay.
So I don't have the best app. I'm sure there's other apps too. And
okay.
I'll look on my phone. I can share later.
Okay.
But I'm a little old school. I use Excel for the most part.
Okay. Good stuff. All right. How about you, man?
I mean, I would say the biggest thing, obviously there's a lot of good investment accounts and things out there, but the biggest thing is just living within or below your means. I think that's something big in our society of like being flashy and all this, but it's like the best thing is to maintain it low, so that you don't get to a point where it's unmanageable. And so that would be the biggest thing I would think is just, and realizing that in the long run, it helps you more to be a little bit more conservative with the finances, just because, life is short and you never know what can happen. So having that mentality of having money put away, not always needing to spend because at the end of the day, like that's not what makes us happy. So, focusing on other things and just really trying to be conservative and budget and live below the means. I think that's the best.
Yeah, absolutely. Yeah, and I saw this video the other day and she was talking for specifically like people who are high earners. A lot of times there's a mental roadblock when they hear budgeting, right? 'Cause these are people who have disposable income. They're like, you're telling me I can't have fun, I can't spend the money that I have, right? And it's like really not saying that. It's not like, hey, just save all your money. It's like, hey, be strategic and be smart with how you spend it, right? And how you allocate it. I mean, you look at your credit breakdown in terms of 35% goes to your payment history, 30% goes to the amount owed. Like those are like the breakdown of your credit. So you should have a breakdown of your finances as well. But hey, I'm spending 20% of my income on vacations, or 10% on savings, or 10% on giving to the church, or like whatever those things are. But being able to have a breakdown. So I mean, I think everybody should have a spreadsheet. Like, you know what I mean? Like whether you make your own. I actually purchased.
Yeah, it does. When you see it.
Oh, it's
I spent $40 at McDonald's again.
It's crazy. And so I bought one, and I'll put that in the links in the description. That's really good. And there's like all these like different. It consolidates everything and spits it out into good little formulas. So find something to track your money. And if you're not going to do it on a monthly basis, at least do it on a quarterly basis. So at least you kind of know where you're at. And that's if you make $200K a year or you make $50K a year. You should be tracking your money. And it's not all about just like not going to Starbucks anymore, right? It's about like, hey, what am I prioritizing for my life? And being able to think about what are my long-term goals? Like, what is it that I want to accomplish? Because you can do anything you want to. There's resources, there's people, there's creativity. You can make it happen. It's just all about like, are you willing to do the work? So any last things you guys want to leave us with? Like, if this is like the one thing you could like pin in somebody's brain if they're watching this episode, like what would it be?
Well, one thing I wanted to piggyback on what you were saying is another thing I would focus on is paying debt down as quick as possible, having that as a primary focus. Just to not, like, for example, you mentioned student loans. Instead of leaving them deferred, start throwing a little bit of money at it and decreasing that overall debt so that you do have that freedom with your finances and it's not going towards that forever,
Yeah.
So that would be just the last thing on that.
Absolutely.
That
Okay. Yeah.
helps to move things forward and frees up income for other areas.
Yeah, and a strategy a friend of mine used for that was she actually did defer hers, but she still was making the payments for them, but she was putting them into a high yield savings account, right?
That's
so she was
awesome.
earning money on the money
On
and
them.
then she paid it all off at once, right? And I was like,
cool.
Good
that's
game plan.
genius. Like, you know what I mean? But that takes like discipline because she had to
Yeah.
make sure she put the money that would have gone to the account. She had to put it in her savings account every month, right? And so if you don't have discipline for that, then you got to build that discipline. But that was another strategy that you could use for that one.
That's really cool.
Again, it depends on your situation. If you can
Yeah.
pull that off, I think you can, but that's a good one. So, yeah.
Yeah, I think my final thoughts is like it's not how you start, right? It's how you finish, right? A lot of people feel like, hey, I can't do this because I have such a bad start. But I was like, it's fine. Like we can overcome it. We can figure it out. We have to make a game plan. As long as you follow through with the game plan, we'll be fine, right? If you follow a workout and you follow what you're eating, chances are you're gonna get the results you want, right? So, and the thing is, numbers don't lie, right? So we're gonna see if you're following your game plan 90 days from now. So if you
Right.
track it, you stick to it, we're gonna see results, right? It might take 90 days, it might take 180 days, but we will see the results in the future based off what you do today. So
Yeah.
what you do today does matter and can impact and get you the results you want.
Yeah,
Just
and
get started.
yeah, I love that. And we're not just talking about people who sometimes like doctors or people who have like the hardest problems with credit, right? Because like they
Oh,
have so
yeah.
many student loans
always
and like
surprised.
so like we're not talking about like just like poor people here. I mean, we're talking about people who actually sometimes earn a lot and are still trying to move finances around. And so definitely don't count yourself out. I don't care where you're at in life financially or what kind of job you have. Like all this stuff still applies to you. So thank you guys for coming on. Y'all were absolutely amazing. We definitely need to do a part 2 of this because I'm sure we're gonna get a ton of questions. And so if you have questions, put those in the comment whether you're watching on TikTok, YouTube. If you're on YouTube, hit the subscribe button, please. And also give us a like because I know if you're still watching, you're getting some value out of this. So go ahead and hit that subscribe button and give us a like. And then put something in the comments if you have a question. And then Maddie, myself, or JD will get back to you. And then we'll answer some of those questions on a second episode. So thank y'all for watching the Blueprint Podcast. See you next time.